Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, giving you all your insights about retirement accounts. Today we're going to talk about some what I call new ETF funds. BALQ, the iShares Nasdaq 100 Income, fairly new fund. We're going to break this thing down. We're going to put it up against TDAQ, the Tap Alpha Innovation 100. So we're going to do a comparison with that, and then up against the granddaddy GPIQ, which a lot of people say is the new king of the hill. So we're going to give you some quick comparisons about these funds, see where they're at, and some breakdowns. Maybe you've never even heard of BALQ. It's kind of fairly new from iShares. So let's get into today's video. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So I want to just give a fair shout out there to our Retirement Made Easy Living on Dividends coffee mug. This is really what supports the channel. $8.99 plus shipping. Real simple, easy to get. Use the QR code on the side. Go to the description down below. You can see the link right there. But basically, guys, we kind of put this together. I cannot believe how much support you guys have given us. We're almost done with our second full run of coffee mugs, ready to place our third order. Something simple, something unique, something different we thought we would try, and you guys seem to be loving it. So just want to put it out there, our quick ad on our coffee mug for only $8.99. We really appreciate the support, and if you don't be afraid, order one up. Makes for a great late Father's Day gift or anytime around anyone into retirement. So let's start with the big picture. BALQ, TDAQ, and GPIQ are all trying to solve the same retirement problem. They're trying to give investors access to that Nasdaq-style growth while also creating monthly income. Now that sounds fantastic, but in retirement we need two things. We need income today, and we also need growth for tomorrow. And that is right. You still need growth in a retirement fund. And that's why these funds here we really want to take a look at. Are they going to give us income? Are they going to give us growth? All three funds operate basically in the same neighborhood, that NASDAQ growth. But they are all very different houses built on unique option strategies, and we're going to break all those down for you. We're going to start off with BALQ, the iShares Nasdaq Premium Income Active ETF. So let's break down what this fund is, how it works, and go from there. So BALQ from iShares is a fund that actively managed ETF that holds a portfolio of large U.S. cap companies listed on the Nasdaq stock market. The fund utilizes proprietary return forecasting models combined with that quantitative analysis methods. So it invests in large cap NASDAQ listed growth leaders with tech focus, uses that research, then active models for that premium income generation, and the income driven primarily by option premiums, not traditional dividends. Now, I'm going to right up front, I'm going to tell you this. This is on a status, is on my watch list only. And I'll explain to you why. This fund came out in December 2nd of 2025. So we're not even a full year into this yet. And I've always had a policy, you always have to wait between 6 to 12 months before you really invest into any type of a fund that you don't understand and don't know. Because you want to see the track history. You want to see what goes on with it. Now, right off the bat, we're going to sit here and say it has $15.23 million in assets. So realistically, I know it's not a year old, okay, but I would expect this to be a little bit bigger, a little bit larger to be comfortable with. It's kind of on the low range being where it's at currently. Now, the big positive here has the expense ratio of only 0.35%. Okay, now it's also shown a 13.04% year-to-date growth side of it. So doing a very, very good job with the growth side and getting as much out of the growth as it possibly can. Now, when we take a look at it, it only has 270,000 shares outstanding. It does pay a monthly frequency on the payouts, on the dividends. Now, the thing is, the fund's high is at $58.29. It's been bouncing in at $55.50 to $55.75. So it's coming down from its top end already, about $3 down. So this is not uncommon. We've seen that, you can see on the chart, we've seen the W, we've seen the what they call the W, now the reverse W or the M. And I just expect these funds to slowly continue to come down as we see the pullback in the AI and the tech side of it. So this just gives you some ideas behind it of what the numbers look like. Now, how does BLQ generate its income? Well, first off is the equity core. The portfolio focuses on high conviction of large cap Nasdaq listed growth companies. It uses a tech exposure. It's heavily weighted in the technology and innovation sectors. And it has the growth objective that seeks capital appreciation along with current income. It actively overlay with BlackRock models, adjusts call writing based on volatility, which is in today's market, it's been very good because the volatility has been extremely high. It's premium harvesting, so that Nasdaq volatility is sold to collect those attractive premiums, and the distribution flow, those premiums are distributed to that monthly income factor. Now, the strategy trade-off here is the upside participation. Selling calls caps the potential gains during rapid market rallies. Okay, the income type distributions are primarily premium income and not dividends, and the tax content is classified determined by the year-end non-qualified funds. So we're going to talk about taxes a little bit later, but the two things that I want to look at, first off, these things are doing those call writing based on the volatility options. And unfortunately, it does say that they are using some cap side into the side. So if we switch this and went to a rally, you wouldn't get the growth that it's been getting lately. Now, the next fund we're going to look at is TDAQ. This is the Tap Alpha Innovation 100. We've talked about this on the show many, many times. Now, the Tap Alpha 100 with that daily income ETF, and remember that daily income is just their strategy that they use. This one, $227 million in assets. This thing came out September 4th of 2025. This is why I'm saying BALQ. What is wrong with BLQ? Why it hasn't grown its funds quick enough? When you look at the fund here, that's only a couple months older, and it's already broke the $227 million mark. So big difference between them. That's why I put the other one on hold. And you know, with me with Tap Alpha, the TDAQ, I'm excited about this fund. Now the expense ratio is a little bit higher, 0.83, but 8.71 million shares outstanding. Distributions about 12.23, paying out $3.34. Now this fund, what I like about it, it does pay out monthly, but the high was $29.51. It's now paying out around $27 to $27.50. So again, all these funds you're going to have this drop off in April. You're going to see the W come in here at the closer to the end of or middle of June, and then you go to the M, and now we're back to it. All of them are using the similar type applications and following the Nasdaq 100. Now Tap Alpha, the core strategy of theirs is those zero DTE call writing options. Now the daily, and that word daily income, that daily option cycle writes call options on the Nasdaq 100 exposure that expire the same trading day, that 0 days of expiration. So they can change their strategies every single day if they need to. Now the maximum time decay is harvesting the rapid time delay at its peak. That's occurring in the final hours of any option life cycle. And that frequent premium harvesting, repeated daily income generation allows the fund to adapt quickly to changes in the marketplace. This is why we've liked that new tap alpha so well of this right here, this one strategy, that they can change with the marketplace almost on the dime. Now, how does tap alpha generate its income? Well, as we just said, the daily selling cycle. Each day, the fund sells call options on the Nasdaq 100. Now, this continuous cycle generates immediate premium used to fund the monthly distributions. That zero DTE, by writing those options that will expire the same exact day, TDAQ captures the maximum time decay repeatedly while reducing that overnight gap risk. Now, in choppy markets, the strategy thrives in that sideways or slightly volatile markets. Consistent premium harvesting outperforms that static strategies when the direction is unclear. Upside limitations. Now, this one has a little bit of a risk. The sharp intraday Nasdaq rallies are capped by the daily call strikes. So now we're saying a risk here is if you get a rally in the middle of the day taking off, you're not going to get it here because they set the strategy at the beginning of the day. You have to ask yourself how many other funds would actually be rallying from this as well. So that fund sacrifices a massive breakout gains to give you that income. Now, execution complexity. Now, this requires intense daily management. So more moving parts, more monthly overlays, making the most complex strategy in the comparison that we have, which is why you see the higher price across the board. Now, they do have some aggressive yields, and we're going to talk this shortly here, but it's a high cash flow potential, right around that almost 17%, driven by the high frequency of premium collections. Now, this one right now, it's actually doing a great job. You're going to see the price probably drop down some, but realistically, the yield is going to hold in those high numbers. Now we're going to talk to the one that a lot of people call the king. I still think NEOS is still king with the QQQI, but GPIQ, and this is one that's fairly newer to it, but the Goldman Sachs Nasdaq 100. Now the Goldman Sachs 100, I'll start right off with October 24th of 2023. So we wanted to give you something that was a little closer to the other two. $4.62 billion already into it. So again, you can see what I'm talking about. When you're only at $15 million in BLQ, you're struggling. You're really struggling right there, just not getting the numbers. The expense ratio, 0.29, extremely low. 83 million shares outstanding. A dividend of 9.69%, paying out monthly. Now the high was $59.83. It's now playing basically about $3 less at $56.83 to $57.79. Okay, this is an institutional standard. GPIQ current income while maintaining prospect for capital appreciation, unlike rigid mechanical fundings. Goldman's dynamic overlay avoids writing the entire portfolio, leaving room for the future growth. We look at it already is 8% year to date. Now I use year percent because I'm trying to compare apples and apples here. Now GPIQ, this is what's unique about these guys. Again, they use that dynamic overlay. It's an active managed, it adjusts coverage based on the market, the environment, rather than a fixed mechanical rule. They may run 25 to 75% of their portfolio is going to be put out there in the covered call section. Okay, so the technical sells the call options to harvest those premiums when the NASDAQ volatility is active. Okay, when we're in a bull market, you're going to see this thing probably only collecting about 25% of the fund is out there collecting premiums, trying to give you the income. As the market gets more and more volatility, more and more of the fund gets put out there, create more and more income versus growth, and vice versa. The growth balance, the participate coverage, this does not overwrite 100% of it. Just said. They're pretty much between a 25 to 75% of the portfolio, leaving room for that capital appreciation. So the upside participation designed to participate in the Nasdaq's bull runs while generating monthly cash flow. Now, tax efficiency, which again, we're going to talk here, each one of them, but these guys use a ROC, that return of capital potential. Distributions may include return of capital, which is tax deferred. So tax-aware design, Goldman Sachs manages an overlay to optimize the tax returns for retirees. This is why I always said GPIQ is definitely one to be a part of any type of a retirement package across the board. So let's talk about yields. Now I want to put this up there for, again, as you always know, I'm not a yield chaser. Never have been, never will be. Yield is just a number that we can use to see what's going on. BALQ has paid $2.66 so far year to date. It's 4.77% year to date. Now the company advertises a 10.51% yield for 12 months. TDAQ has paid $2.22 for an $8.13% for a 16.98% total yield for 12 months. Now, neither one of those have hit 12 months yet, but you can see already that they're forecasting right out there. The big difference between these two is the price of the shares. When you're talking a $27 share for TDAQ and a $55 share at BALQ, you can see why the yields are so different. And that's what happens with yields, and why I say you never chase yields is all it depends on what's the price of the share, how much they've done in distributions across the board. GPIQ, same thing, $2.82. So you can see all of them are about in that $2 range so far up to end of June. 4.94% and a yield about 9.13. So realistically, TDAQ is winning the yield race for everyone who's looking for that monthly income, and that's income only. You're going to look at TDAQ. Now growth. This is a huge one. BALQ so far has had a great growth. Now part of it can be that it's a newer fund, but coming out in December, coming through the whole spring time frame already, you're at 13.04%. TDAQ is only at 4.79 because you can see the income was more important to them than growth. And GPIQ is giving you that balance between both, about a 9% yield with a 8% growth. But the winner still is BALQ. Now when we take a look at total returns, now this is the number I look at the most, because what this tells you can tell you so much about the fund. Do you see yield in there? Do you see growth in there? Do you see the combination of the two? And BALQ at 18.05 year to date total return tops all three of them. So even TDAQ with that large distribution so far, with that large yield, is showing me that they don't have as much growth, while GPIQ gives you that balanced approach between the two. When I look at total returns, you watch these lines. This is the one that really got me here. The lines match up almost to a T. When the market drops, this one drops, all three drop. But BALQ is just not dropping as much. It's been holding a lot back because of its strategy that it's using. So you can see where the other two are pretty much almost matched. TDAQ and GPIQ almost matched right now, while BALQ is just being able to pull that thing out considerably. Now let's talk about tax treatments. Now this is where, taxing is all about one thing. If you can get big yields, that's great, but you got to be able to keep the money. And this is a downfall so far I'm seeing with BALQ. Now it's a new fund with limited history. Now the initial distributions have shown ordinary income and long-term capital gains. There's no RRC component of this that has been reported. So I'm very nervous about BALQ that it's going to be ordinary income. So if you're in a brokerage fund, that's going to hurt. That's going to be just point blank. Your income's coming to you and you're going to have, whatever tax bracket that puts you into. Now the long-term capital gain is what's really questioning. Where did that come from? Is it products that they've held, that they've done? So we're going to look at that a little more detail exactly, because they weren't even very clear with it, and we could not get in touch with someone to give me more details of that, but for sure did not see any ROC. Now TAP Alpha has a variable classification of their zero DTE options. Now some of their distributions will be with the ROC, the return of capital, depending on which account, of course, you're using. Now, investors must monitor that 19A notice and that final 1099 forms. I really put it anymore. I don't even care what they come back and say. I've seen many funds come back and say 100% ROC, 95% ROC. I want to see it at the very, very end on that 1099 form before I really say that this is a big piece of the puzzle. Now, JPIQ, though, is the most established tax-aware design. It's potentially for that ROC, that return of capital treatment, which significantly improves that tax yields in non-retirement accounts. And that's what we're really talking about, non-retire or the retirement accounts that are non-IRA or non-Roth. Now, the ROC classification, I did a video on this one about, and I explained it very detailed. ROC is actually a very good thing. It reduces your cost basis instead of being taxed at ordinary income. So, but you really start kicking the can down the road because you only start to pay taxes on it is when you basically sell the funds or you liquidate your package completely out. Now, what's bad about ROC is the funds can own principal because of the strategy doesn't earn enough. That gives them the whole authority that they can come back and say, look, we're giving you 10%, guaranteed 10%. Nothing's guaranteed in these type of funds, but they're using your own money, putting it back to keep their yields up at 10%. So if you don't have a company doing the right job, it can be a very bad thing. So, which depends on what account you put this in. If you're going to be putting BLQ in a IRA or a Roth, then you don't have to worry about that whole side of it. But if you're going taxable, I really put GPIQs right where you want to put your money right off the bat. So for best for taxes, bottom line, GPIQ is definitely number one. It's well established. It's well set. BALQ, it's limited. I don't see the ROC. If they had ROC, I'd say, okay, we're probably a little better off to it. So both TDAQ and BLQ, you're on the fence with both of those. So I really just think GPIQ, if you're really worried about taxes, this is the place to be. Now our total comparison. This gives you everything. Our total return, BALQ, wins at 18.05. Okay, it wins because of the growth at 13.04, and the yield that they're forecasting out at that 10.51 is good. But how are they handling the taxes? So I'm expecting that to actually be lower based off of the tax, what I call pocket money, because that's going to be off with it. Now, TDAQ, though, 14.07%, nice total return, but you're getting that primarily from your yield, not so much from the growth, and we always need to have growth. If the growth stays in that 4% range, I'm okay with that one because it's ahead of inflation. And that's really what we're trying to beat is make the inflation work for us. But now you can see why GPIQ just becomes the real positive one here at 13.89 or 13.84%, 8% growth, 9.13% yield, a very balanced, a little bit from each side of the fence. So very pleased on that side of it. But everything works accordingly. What's your portfolio? How's your portfolio built? Where do you go with it? Now let's talk about some risk analysis of it. BALQ, again, early stages. Extremely short track record. It only launched in December of 2025. It's got a small asset under management, which scares me because of that liquidity potential problem. And the active call writing mechanism caps that rapid upside participation. Now, TDAQ is very high complex strategy, but you don't have to worry about that. They're managing that, but it is a risk. It's very high complexity. The daily zero DTE executions requires intense management. And frequent call writing severely limits the breakdown of growth strategy. That's why you see their growth so far down. And then GPIQ, I'll tell you, is that systematic link that it's a high concentration in the tech-heavy Nasdaq 100 names. The dynamic overlay may outperform in virtual bull markets. Monthly distributions vary based on the market premiums. So these are some of the things that you have to worry about in each one of the funds. So my final verdict of all this, I still put GPIQ as my core fund. It is number one to me. I think Goldman Sachs does a great job with this. It's a dominant asset base at $4.62 billion. It's got the lowest expense ratio. There's so much to talk about. It's got proven 1 year total return numbers. Very, very strong. And you got the ROC for your tax side. Number two, though, is the satellite. I call it the satellite. There's a TDAQ. I do like this fund. I've liked this when it first came out. I thought Top Alpha did something awesome about this. I like the zero DTE strategy because I understand it. I know it very well. It gives them great, great big income. But, this is a part. I would put this into my income stream, and I put JPIQ in my income stream. But this one, I'm not going to put all my eggs in this basket. Okay, that's why I call it satellite. I'm going to put some into it. I'm going to put a healthy amount into it to capture that 16% yield that we're looking at. But I'm also want to make sure I'm getting my growth from other areas, which again would be GPIQ. Now, number three, I put this strictly on the list because of the watch. It's a watch. It's too new yet. I need more time under it. But I wanted to get some people's opinion on this. BALQ from iShares. It's got some promising early performance numbers. It's looking very, very strong so far. It's got some competitive low pricing that we can go up against GPIQ with, but it really requires that 6 to 12 months of additional live history to prove what it's going to do. And in today's markets, with the ups, the downs, I can see it following what the other ones are, but are they going to continue to keep that total return numbers as high as possible? Let me know your thoughts in the comments below. Leave a comment down below. Don't be afraid to hit that like button if you like what we're doing. I'd love to hear, is BLAQ a one to keep on our watch list? Or maybe you already own it. I would love to hear if you've already owned it. What do you think of it? Let me know in the comments below. And don't forget about that coffee mug.